If you ever want to make money from day trading, swing trading, or even scalping, then there is absolutely no way around it. You must have a strategy that makes money over time. This strategy must be based on a set of rules so that you can stay consistent, and the strategy must be capable of weathering the storm of different market conditions. Sadly, without that, there's no way you ever make money trading in any market. But no worries, I always got your back. That is why in this video, you are going to learn what I consider to be an incredible strategy for beginners because of how simplistic it is, and also a good strategy for pro traders because of its profit potential. In just a second, I will be diving deep into every detail of what I call the 200B strategy. That way you come away from this video having a strategy that does make money over time, that is rules-based so you can stay consistent, and that can weather the storm of different market conditions. So if that sounds good, go ahead and click that like button for me. Go ahead and subscribe if you are new. I'm gonna let the intro and disclaimer roll, and I'll see you directly after. As I said, this is an extremely simple strategy only consisting of 3 components, but these 3 components come together to create some highly accurate trading opportunities that can provide really good reward to risk opportunities as well, just like we have here on the Aussie Yen. On the Aussie Yen, I have a trailing stop in place at an 11.3 to 1 reward to risk ratio, and this came from the strategy you're about to learn. So first things first, let's go up here to whiteboard and I will break down the entire strategy for you. So for starters, we're looking at swing highs and lows. If a market is doing this, these new lows from our previous low to our new low, that is a swing low. These new highs, we go from a previous high to a lower high. Those are swing highs. We're looking at these swing highs and lows, and this is normally what a downtrend would look like. What we're waiting for is price to push up and break through the previous swing high. That is our first component of this very simple strategy. We then want to see price pull back to that previous swing high. This being our first component, our second component is actually this combining with a moving average. So this is going to be the 200 EMA, and what this does is it combines, it stacks up 2 different areas of value. The first area of value being the previous resistance level price just broke, telling us that price is likely to reverse and start heading up from our previous downtrend. The second area of value being the 200 EMA. As price comes down to the 200 EMA, we want price to at least touch our area of value and at least touch the 200 EMA. Then our third component is some type of candlestick pattern. For this example today and what I used on the Aussie Yen trade, we're going to use hammers and shooting stars. At this point, we have stacked up 2 areas of value and a candlestick pattern all coming together to prove that we have a higher likelihood of price continuing up at this exact moment than it continuing down. And if you add that to a good reward to risk ratio, you come away with profits over a long period of time. So let's really quickly go over a bearish version of this, then we'll go down to some real charts, check out the Aussie Yen trade, and I'll break that entire trade down using this exact strategy. For a bearish version of this strategy, we would see price going up this time, making new swing highs and lows higher than the previous swing highs and lows. And then we would want to see our first component for a bearish trade is a break of the previous swing low. After that break of the previous swing low, we would want to see price pull back to that previous swing low. We would want that to combine with what? A 200 EMA, which I'll show you how to put on the chart in case you don't know momentarily. After we combine our 200 EMA area of value with the previous level of structure support that was broken and now should become resistance if markets are trading in a technical way. What are we looking for after that? After that, we'd be looking for, in this case, an upside down hammer, a shooting star, a candle with a long wick to the top side. Does not matter what you call it. All of them mean the same thing. They all mean selling pressure. And selling pressure in combination with the other factors we have, like price at a previous support that should become resistance, like price at the 200 EMA, mean that we have a higher likelihood of price continuing lower and hopefully hitting our profits if we're going short. So now that I broke down this strategy on a whiteboard in a really quick and broad way, let's go ahead now and take a look at some real charts and discuss how you can use this strategy to start making profits in your own trading account. Here's our first example on the Aussie yen. Let's break it down. So the first thing we need to see is price starting to trend in the downward direction. I'll draw out our swing highs and lows. We go from swing high to swing low, back up to lower high, down to lower low, up to lower high, down to lower low. We continue this process of lower highs, lower lows, lower highs, lower lows, until eventually what happens? Eventually, this happens. We reverse. This is our first sign that price wants to start heading higher at any point. When we see lower high, lower high, lower high, lower high, lower high in combination, and after that, we see one of those lower highs broken, that is our initial sign that price could possibly be reversing. For this strategy, one of the things we're looking at is that previous swing high that was just broken because it can act as a major level of support. So if I do this and we draw a box zone, because these areas are going to be zones and not necessarily a line on the chart, you can see that price, after breaking above that swing high zone, did in fact pull back into it. Now, what's the other thing we have to see? We want to see a combination of confluence from a technical analysis standpoint. Trading this on its own, just the break of this previous high, can be profitable, but not nearly as profitable as if you combine this with another area of value. The 200 EMA is a major area of value. So now that we've seen our first rule met, we need to see price at least touch the second area of value, which is the 200 EMA. Do we get that here? Of course we do. We can see this wick of the candle come down and hit our 200 EMA. Therefore, the first two rules we have for this strategy are met. If we zoom in a little bit closer here, you can also see that the exact candle that touches the EMA, in fact, is considered a hammer candle or a long wick candle to the downside. Whatever you want to call this is irrelevant. This is just an indication. All of this wick followed by buyers eating that wick up and closing up towards the top of this candle, that is just a sign of buying pressure. And when we combine that buying pressure with our area of value confluence, we get a really high likelihood of having a really nice trade. Now, let me mention this to avoid giving anyone some kind of false hope. This trade was a very good trade, fantastic trade, by far my best trade of 2022, hitting an 11.4 to 1 reward to risk ratio, 11.5, whatever it is. But this is not a typical trade using this strategy or any strategy. There's not a strategy out there that just wins all the time at some huge reward to risk ratio. What most beginners tend to think is that that is the case. Most beginners tend to think that if you are a winning or a professional and a profitable trader, that means you don't lose. That means you just make money. You make trades like this all the time. Guys, I'm going to tell you that's not the case whatsoever. I have weeks that go by where I don't make any profit whatsoever. It's called a drawdown. It happens a few times a year where I can go weeks without making profit. And unfortunately, when you're first coming into the Forex market or any other trading related situation, you're not told that, because everybody wants to show you these kind of trades and then hide the fact that there are periods of drawdown in between these types of trades. And then there's a lot of trades that just hit a 1.5 to 1. Or a 2 to 1 reward to risk ratio, or sometimes even less. The point of a strategy, yeah, I wish they could do this all the time, but the whole point of that strategy that you're going to have, if you choose to have this one, the entire point of the strategy is to give you a statistic advantage that plays out over a long period of time. So just remember that moving forward. I know I got caught in it. I looked for the holy grail strategy for a very long time in my own trading career. And as a beginner, that's truly what I thought was out there. That's what I thought was possible, but I'm here 10 years later. I've been trading for a decade. There is no holy grail. You will be much better off accepting the fact that what you're going to do is make money over time through the process of small wins with big wins in between and managing your risk correctly. So after my little rant, let's move on with the video. Looking here on the Euro Canada for our bearish example, what has price just done? If I draw a little line here, we'll even make a little box here at a previous level of structure. You can see that price has just come down and broke through that level of structure. So now what are we waiting on? Well, we want to see a pullback into that area. As we can see, that is currently happening. The next thing we need to see is price touch our second area of value, which is going to be the 200 EMA. Now, if I push the market forward, what happens right there? Right here is our actual reason for entry. So what price has done is pulled back to a previous support level that was just broken by price. It's also pulled into the 200 EMA, which is drawn very well right there. But it's also pulled in the 200 EMA. And what else has happened? We also have a candle with a long wick to the top side. And what does that tell us? That tells us that selling pressure is coming into the market, at least for this candle. And it tells us that we have a higher likelihood of price going lower than higher. And again, if you mix that with a good reward to risk ratio, you end up a profitable trader as long as you follow solid risk management and have good enough trading psychology and discipline to stick to it. If we click play here, you'll see that this trade, in fact, did work out and start pushing price lower before eventually pushing back up, right? A bullish example here on the New Zealand dollar. What has price done here on the New Zealand dollar? We've pushed up. Have we broke above the previous high? Yes, we have. Our previous high looks a little something like this. Create our zone of structure here at these highs. After price breaks above it, what's the next thing we need to see? A pullback into that area of structure, along with this pullback hitting our 200 EMA. Pushing forward here, you can see the price, in fact, does pull back into our area of structure and the 200 EMA. And after that, we get a really nice long wicked candle to the bottom here, showing us our hammer candle, our upside down shooting star. Again, no matter what you call it, this wick and closing it towards the top of this candle shows us buying pressure from an area of value that has confluence between two technical factors using the 200 EMA and previous resistance that should turn into support. Here on the Swiss yen, price has just done what? Broken below our previous low. Here's our low, our lower high. We break below that low. We cross under our 200 EMA. We then pull back to that 200 EMA. Right here, do we have a combination of the previous low that was broken and the 200 EMA? Yes, we do. That pullback comes up into that area and we get that nice shooting star / upside down hammer candlestick pattern. What do you think is going to happen next? We should definitely see the market push down. Oh no, we were wrong. If your strategy is not making money right now, then it is because of one of just three very simple reasons. And before we dive into those, if you enjoyed learning this strategy and you enjoy learning about Forex trading in general, then I think you would really enjoy the TTC Forex University. So if you're ready for some more advanced training, and if you want a step-by-step guide showing you how to go from wherever you are to profitable trading in as little time as possible throughout an entire university style course that has over 70 videos that essentially is a glossary that's organized of everything that I've learned in my own trading career over the past decade. The university also comes with priority coaching support from yours truly. And along with that, we also send out a best setups of the week video each and every Monday and an email showing you what I'm looking at in markets throughout the week. Next week, we're going to start sending out email analysis in the university. So if you want to be a part of it, then the link is in the description, or you can go to ttcfxuniversity.com. If not, that's no big deal at all. Let's move on and start talking about the 3 reasons your strategy may not be making money. Okay, so if your strategy is currently not making money, please listen up, because it's one of these 3 reasons that is the case. Number 1 is that you don't have rules to stay consistent to that strategy. So if you are trading what you think is a strategy, you're more than likely just trading an idea and calling it a rules-based strategy. For example, if you say, I'm trading double tops and bottoms, Steven, I know you trade those, and that's what I decided to do. And I know you trade those at areas of structure, so my strategy is that I trade double tops and bottoms at support and resistance levels. You tell me, comment below if you'd like to. Is that a strategy? Is that a rules-based strategy someone can stay consistent to? Selling double tops at resistance, buying double bottoms at support? No, that's an idea, not a strategy. Let me explain why. If you say that, then what are your rules for a double top and a double bottom? Because sometimes a double top can look exactly symmetrical. It can look like an M. And then sometimes it can look more like what we have right here on the chart, where we see price come up to a level, then price go a little bit higher. So is this a double top in your eyes? according to your strategy, according to your rules? Because if not, you're going to have a really hard time. And when I say if not, I mean if you don't have rules, you're going to have a really hard time staying consistent to that. So the first reason I see traders trading strategies that should be profitable, but they're not profitable using them, is because of a lack of rules. This might be a double top, that might be a double top, this might be a double bottom, that might be a double bottom. Also, what's your reason for actually entering the market? Because a double top and a double bottom are not entry reasons. Those are just patterns. Why do you actually press the buy or the sell button? What's your reason for entry? Also, what's your stop loss? Where are you getting out in case things go sideways? And in case, when I say sideways, I don't mean consolidation. In case things do not go your way, where's your stop loss placed? And when things do go your way, where's your target placed? So these are the little nuances that come along with a strategy that most beginners don't think about, and it's a large reason that a strategy may not be working out. So for that, and with that being the case, let's actually take a look at the whiteboard, and I'll explain to you how I fix that problem by ensuring that all of my strategies that I trade are as rules-based as possible. I do this through a process I call CEST. I know that sounds weird, but it's just CEST. It's essentially an acronym for conditions, entries, stops, and targets. Every strategy that I make, use, learn, I have to break it down in this CEST format. Conditions, for example, would be things like the market's in a particular trend, the market's at a level of structure, price creates a double bottom. All of these would be conditions. The RSI is oversold or overbought. These are all just examples of different conditions, and what we have to do to create a strategy is combine a number of these conditions together to give us a probability of success that's greater than 50-50, or give us the high likelihood of having a large reward to risk ratio. Essentially, we create these conditions in order to give us a statistic advantage. So after we have our conditions met, you need to know why you're actually pressing the button. Otherwise, you're going to be inconsistent. You can either press the button, enter the trade through a candlestick pattern, through some kind of limit order, through some kind of buy or sell stop order with a breakout. The point is not having the perfect entry. The point is having rules for your entry so that you're consistent with a strategy. Because why? Because the number one reason that most traders are trading strategies and not making money with those strategies is because they're inconsistent to them. Think about your own trading. I know I dealt with this at the beginning of my trading career, guys. I'm speaking from experience. The reason I'm telling you this is because I went through it. From your own experience, can you remember a time that you were just randomly placing trades and weren't consistent? And did you make money during that time? I would imagine the answer is no, because I know I didn't at that time. After we have an entry reason and our conditions met, it's really important to at least know where we're getting out of the market. If we're wrong, setting a physical stop loss, a lot of people have a problem with that. I don't. I set a physical stop loss order for every trade I take. You don't have to do that, but at least have an idea of where you're getting out when you're wrong, because otherwise you have unlimited risk on the table, and that sounds like a great way to blow your entire account. After you have your stop loss area in mind, have a target area in mind, and this can change. You can adjust your targets as price moves. At the beginning, if you're a complete beginner, I would have set stops and targets. As you gain experience, you can play around with these. But CEST is how I always avoid the first problem that a strategy has. The first reason a strategy will not make money is if you cannot create or mold a strategy into being rules-based, and the way I do that so it's consistent is create it using CEST. And this can work for strategies you learn, not just create. You can add different conditions to strategies you've learned, or if someone taught a strategy and it wasn't objective but instead really subjective, you can create rules around their taught strategy, around whatever philosophy they had in their trading. So that is by far the number one reason that I see traders trading strategies that should be profitable, but the strategies not being profitable. What is reason number two? Reason number two is that you're trading a strategy that is just pitiful, that is literally just not profitable. You're trading based on something, it could have rules behind it, but it doesn't matter if it has rules if it doesn't make money. So the second reason is trading a strategy consistently, but it's not profitable. how do we avoid or fix this issue? Well, through a very simple process called either back testing or called forward testing. A lot of people have problems with back testing, and that's completely fine. But if right now you're trading a strategy you randomly learned on YouTube, I don't care if it's from our channel. If you're trading a strategy that you have not tested in some way to see if it is actually profitable over a long period of time, I'm not talking about 10 trades, I'm talking about over a long period of time. If you are trading that strategy with real money without ever having tested it, you, in my opinion, are making a huge mistake. And you fall into the category of what I've seen in the past 5 years of teaching traders being the second largest reason that their strategies are not making money. So the solution to this is whatever strategy you're trading, if you haven't tested it, do not trade it with real money. You don't have to backtest if you don't want to. Spend 3 to 6 months in an account with fake money. I know that's a lot of time. I know it sucks, but guess what? Trading's not easy. So spend that amount of time, 3 to 6 months, in a demo account to ensure that placing the trades you're placing based on that strategy do give you an advantage over a long period of time. That is the solution to if you're trading a strategy right now that's not profitable. The solution being, at the end of 6 months in a demo account, at the end of backtesting hundreds or thousands of trades, you will know whether or not that strategy has a very high likelihood of making money or has a very low likelihood of making money. So that's the second reason that I see strategies fail that traders are trying to trade. Reason number 3 has absolutely nothing to do with the strategy. Reason number 3 comes down to risk management or trading psychology. So you could have a strategy that is making money or that should make money over a large sample size of trades, like 100 trades. It should make money in that time. But you're using a terrible risk management plan, or your trading psychology is all whacked up. So you're changing strategies constantly. You're moving your stop or your target constantly. You're not following your rules. So your trading psychology is just whacked up. Or you're using such bad risk management that you can't give your strategy time for that edge to play out. It needs time. And in order to give it that time to play out, that 100 trade sample size, you have to have a risk management plan in place that keeps you out of your emotions during drawdown periods. So to give a good example of this, I actually discussed this with one of our traders the other day. He sent me a message, and in the email, he was like, man, I am down 30% right now. The strategy you just taught me in the course, this is one of the strategies from our course, so it had me boggled, was just complete shit. I'm down 30% in my account. I'm only winning like 32% of my trades. The rest are losers. So I immediately went, okay, this guy must be doing something wrong in the strategy because that's not how it normally performs. I'm normally hitting well above a 50% win rate with this strategy. What's this guy doing wrong? So I was like, hey man, so sorry to hear about your losses. Send me your trades, your results, and send me all the trades. Send me a screenshot of the trades you've placed, and I'll get back to you if I see anything wrong with them. Also, what risk management plan are you using? I should have known on his second email when he didn't send me what risk management he was using, but instead he sent me a picture of 7 trades. And he said, yeah, 2 wins, 5 losses. I was like, okay, cool, man. It looks to me like you're trading it correctly on these 7 trades. Send me the rest of your trades. Like if you're down 30%, send me all the trades you've taken. I want to really dive deep into this and try to help you solve this issue. And he goes, nah, man, that's all the trades I've taken. Now think about this for just a moment. This man has taken 7 trades, 1, 2, lost 5, and he's down 30% in his account, and he's complaining about a bad win rate. What is the point of this story? Your win rate over 7 trades is completely, and I'm being completely irrelevant. It's going to fluctuate so much in that small of a sample size that it means absolutely nothing. So this trader is a very good example of someone that used poor risk management, and because of it, didn't give the strategy a long enough period of time for its edge to play out. So instead, he's emailing me after having 7 trades, that's all he's taken, and having a 30% drawdown in 7 trades. And I emailed him back. I'm like, hey man, we got to work on your risk management for 1. And number 2, your sample size of 7 trades, the winning percentage is completely irrelevant. Work on looking at 100 trade sample size to see the correct outcome that you can expect from a strategy, the correct winning percentage of a strategy. It will not show it to you until you have a large enough sample size of trades for that edge to play out. So the moral of this entire story is, if you have bad risk management or bad trading psychology right now, the first thing you can do is reduce your risk, because that's going to help with trading psychology already. And the thing you can do to help with trading psychology is reducing risk and testing / demo or back testing that specific strategy. So that's the third reason that I see strategies failing that traders are trying to trade, and the solution to it. Hope you guys enjoyed it. Go ahead and subscribe, click that like button, go ahead and click the notification bell so you're alerted when we come out with new videos. Don't forget, we have some space available in the TTC Forex University. And if you enjoyed this, I think you would, hats off, enjoy the TTC Forex University as well. I hope you guys have a great trading week. I hope you have a great weekend, because it's actually Thursday right now. The weekend is coming up quick. I'll be in Miami, Florida. So if you're in Miami this weekend, hit me up. Go ahead and post in the comments or something. I might do a little meetup in Miami. But with that being the case, I'll let you guys go. See you next week. Talk soon.